Okay. Welcome back to the program. In case you're just tuning in, this is Moneyline with Nancy on African Independent Television. Earlier on, I did mention about what we're looking at today on the show. Overcoming debt and generating growth is the conversation that the World Bank Group president did lead, David Malpass. And in fact, like I mentioned at the beginning of the program, not just Nigeria, countries like Ghana, many African countries are also struggling with debt. Some are seeking for debt relief, but Nigeria is not seeking for debt relief. What Nigeria has constantly said is that it has a revenue challenge or a liquidity challenge. But what this next conversation is going to be talking about is what can be done to avoid debt crisis and generate growth at a time when public debt levels are at 50-year highs, according to the World Bank. And this conversation that you will get to watch right now is bringing together academic experts, policymakers from developing economies, and private sector representatives to discuss the potential solution. You will get to hear from the Minister of Finance of Ethiopia, Ahmed Shide. You would also get to hear from Nigel Clark, who is the Minister of Finance and Public Service, Jamaica. That discussion was very stimulating as well as inspiring, especially talking about lessons that we can learn from Jamaica that struggled with so much debt and try to clear it, I think, in 2010 to 2013. David Malpass, the president of the World Bank Group, like I mentioned earlier, led the discussion. We also have Tina van der Stil, who is the head of Emerging Country Debt, GMO. Then we also had Professor Rajan, who is a professor of finance at the University of Chicago Booth School. Let me just hold my fire here for you to listen into this conversation. And I hope that, of course, our policymakers are here, really, I must say, at least talking about the Minister of Finance and the central bank governor. They have been engaged in various high-level discussions at the IMF headquarters here, as well as the World Bank. And I do hope that when we do listen into this, we will get to see how, or we will even get to observe, or we'll get to listen in to how some of these countries have been able to deal with the issue of debt. Something interesting that the Ethiopian finance minister did say, but let's quickly take you through it, and we'll be right back.
We'll be discussing how to unlock growth and poverty reduction around the world. We start the week off with debt sustainability. That's a topic that is key for growth and development. Around 40 low-income countries and a dozen middle-income countries are at high risk of debt distress or in debt distress. In addition, slowing global growth and higher interest rates globally are putting additional pressure on developing countries. The World Bank has advocated strongly for solutions to the mounting debt challenge facing developing countries, and we've been providing fresh grants and highly concessional resources to countries in debt distress, often when no one else is providing financing. Along with the IMF and India as the G20 president, we are co-chairing the Global Sovereign Debt Roundtable. It brings together a wide range of stakeholders and aims to bring consensus and recommend measures to accelerate debt relief. The in-person meeting of the roundtable is tomorrow. Progress on debt has been stalled, and it's urgent that we move forward promptly. Countries need to achieve transparent and sustainable debt burdens in order to restart investment, which has slowed to a standstill. Today, we're bringing together this illustrious panel to discuss the latest difficulties in sovereign debt markets and possible solutions. I'll turn to Professor Rajan with my first question, and that's a general question. Professor, will you describe the debt context for the world and what the global context is of the challenge that we're facing now? Thanks.
Sure, absolutely. Let me very quickly go through the obvious, right? These are difficult times. Interest rates around the world have been rising. Hopefully, the Fed doesn't have too much more to go, but clearly it seems as if the ultimate way inflation will be brought down is by a slowing of the economy in the United States, either because of higher rates themselves or because of financial sector credit contraction, or some combination of the two. So we are going to get slowing growth in this country, probably also in Europe, where core inflation is still very strong, and perhaps some slowing is necessary to bring those economies back on track, on the inflationary track. And of course, with higher interest rates, we've got higher real interest rates, and on the cards in times to come. For now, it's a little bit of a wash, depending on what nominal interest rates are. But over time, we will have a period of higher real interest rates while we're trying to slow down the economy. And of course, higher real interest rates feed into the rest of the world's debt, because they determine the rollover rates for the debt there and become a higher burden when you include to that credit spreads and so on. The risk-off pattern in global capital is also a concern for many emerging markets and developing countries, in the sense that it becomes significantly harder to roll over debt. So all this is, stuff that you know, stuff that you are cognizant of. What is more worrisome is the enormous spending needs that many emerging markets and developing countries now have. As you know, they had a terrible pandemic. The lower middle class in many countries didn't have regular jobs, certainly when there were lockdowns. Many small and medium enterprises, certainly in my country, India, suffered tremendously during the pandemic. So these months have been periods of slow recovery for large segments of the population, segments that didn't have regular employment, and small and medium firms that didn't have regular business. And in this time, what we're seeing is an interrupted recovery, as we have higher interest rates, difficulty in borrowing, interrupting the process of recovery. So the bad pandemic is one source of concern. And of course, a bad pandemic leads to bad politics. One of the articles in the Financial Times today was how insurance companies are paying out more for unrest, for losses due to unrest. And that's a feature that is emerging in many countries, because the lower middle class is extremely upset with what they've been through over the last few years. That doesn't make for good politics. So bad pandemic, bad politics, and therefore bad, often macro policies in a number of countries. That if already capital is a little worried, that pushes capital even further away. We've also got, interrupted development. The pandemic sort of slowed down development in a number of countries, enormous development needs, as we well know across the world. But add to that the concerns associated with climate change, the fact that, farmers in Pakistan are still dealing with the consequences of the flood last year, that these are increasing catastrophes around the developing world that need to be dealt with. Often they need quick spending, not so much on mitigation, but on adaptation and resilience, which are important for their continued well-being. So all these imply enormous spending needs. And last point, and I'll stop there, where's the available capital? With industrial countries basically having big spending needs of their own, both in terms of higher government spending through the pandemic, which will wind down slowly, but also the enormous new spending that a number of countries are contemplating on climate action. So what is left is significantly smaller for the rest of the world. There's a crowding out happening, not so much of private capital, but of capital to the rest of the world. So this is the environment, hopefully I've touched on the big themes, in which we want to talk about the specifics of what's happening.
Yeah, thanks. This is a huge problem of the absorption of really the whole world's capital by the advanced economies at a time when the developing countries need some kind of new investment in order to get over their spending needs and address the climate costs that are large. And you didn't so much mention it, but we will be discussing it all week, is the debt restructuring that's so important, because the countries are still paying so much for debts that were incurred over the last decade that it creates challenges for their spending side as well. So let's turn to Minister Sheed. Ahmed, Ethiopia requested G20 Common Framework treatment a little over 2 years ago. It's still waiting to pick up steam. Tell us a little about the debt restructuring process. Why is that important? How does it affect your growth and your sustainability as a country? Thanks.
Thank you, David. First of all, I would like to express my appreciation for the G20 initiative. This is a timely initiative, and it is very important, particularly given the challenge we are undergoing as a developing countries like Ethiopia. But the process, as you have said, took more than 2 years since the initiative has been announced. We have applied it, and the process was very, very slow, and that is one of the challenges. Ethiopia's macroeconomic imbalance has widened recently due to internal and external pressures and the shocks that have challenged us. The drought, the war in Ukraine, all have significant impact in terms of deteriorating external positions and declining of international reserve. And that's why debt treatment and also additional reform measures is very fundamental to close the gap in terms of macro imbalance and to move to sustainable trajectory. I would like to note that also for the last 4 years, since the new government has been in place the last 5 years, we never had any borrowing when it comes to non-concessional borrowing. We have a very stringent requirement on non-concessional borrowing limit, and we have adhered to that one to make sure that we have a fiscal discipline. We are currently working with IMF and the World Bank in restoring a macroeconomic imbalance through our own homegrown program, reform program, which is very much important to address the imbalance we are having. Ethiopia's situation, in terms of debt situation, is different from Chad, Ghana, and Zambia, because Ethiopia does not have any external payment arrears so far. Our debt parameters are very clearer and more straightforward. We do not have any challenge that other countries do with questions about residency and domestic debt holding as well. Ethiopia's biggest challenge is most of the repayment of the loan has to happen within the coming few years.
The coming what?
The coming few years, we need to repay a lot of debts.
Yeah.
Significant chunk of the debts is going to be repaid within the coming few years. So that is going to put us in a very significant pressure, given the export level, which has to yet to grow. Therefore, debt service to export ratio is also deteriorating. So the external imbalance which is happening due to global food shock and other commodity price increase has exacerbated our external positions. So Ethiopia's challenge is not only internal, it's also external challenge which has exacerbated. Of course, the conflict and the drought and all has contributed also to the shocks we are enduring. That's why it could have been because of our reform measures that we built some level of resilience in our system. Even the situation could have been worse without the reform. The treatment we need in terms of debt treatment is not complex. What we need is for the decision to come through quickly. We had a fruitful discussion with IMF team recently for a potential program. We are continuing to discuss with both IMF and World Bank for a potential program. And I expect the DSA should be shared with the creditor committee, but we need to move very quickly. The time is of urgency, and I think slowness in the common framework, in the giving of DSA data to creditor committee, more coordination between the bank and IMF and creditor committee as part of G20 common framework is very, very vital. Thank you, David.
Yeah, thanks. And so you mentioned the DSA, so the debt sustainability analysis is a product jointly done by the World Bank and the IMF, and gives some concept of what the financing needs are.
Definitely.
And each country is quite different. Ethiopia has more of a liquidity problem.
We don't have a solvency problem. Mainly, it's a short-term liquidity challenge.
Short-term liquidity challenge that would come out. And so one of the things we're pushing strongly for in the debt roundtable tomorrow is early sharing of the DSA with a more inclusive group. It's been kept private within the in the IMF and World Bank for all these years, when it's a vital document for all the creditors to think about. The country itself can benefit from looking at the debt sustainability analysis, and the private sector. So I'll come to Tina van der Stil. Do you look at DSAs, debt sustainability analyses put out by the IMF and the World Bank? How do they affect your thinking on countries? And the bigger picture question, how do you think, what would be good for catalyzing new investment into poorer countries, into developing countries? We think a faster debt restructuring process would actually be helpful. But what are your thoughts on the timing of a debt restructuring process, whether it's a good idea, and then what documents would be helpful to get it done?
Absolutely. Thank you for having me. And to be clear about representing the private sector here, I work for an asset management firm, so we represent savers of different varieties, including pension funds and endowments, sovereign wealth funds, that type of thing. So generally, when people think about the private sector, they're thinking about, well, how does the private sector think about lending to an emerging country in the first place? And if you start at the highest level, the asset allocation level, they see emerging debt as an asset class like any other lending asset class, corporate credit, either investment grade or in this case, sub-investment grade. And what you're going to look for is a return that is in excess of expected credit losses. Right, so sovereigns have defaulted over time. We have a lot of history of sovereign defaults. And so you can project some of those. And a DSA is a terrific way to socialize the IMF and World Bank's thinking about the sustainability of the debt. Because if you think about it from a lender's perspective, and you know that there's some chance that the country will run into trouble, it's good to know whether or not the IMF or World Bank thinks that, what are the assumptions that they're making, because obviously debt sustainability is a fluid concept, conditional on the macroeconomic environment. Debts that were sustainable before the pandemic may not be after the pandemic. Unforeseen things can happen. So for sure, as an anchor, it would be critical. And from the point of view of transparency, which is, of course, a key theme in the common framework, investors would love, at all stages, more transparency. More transparency lowers ex-ante debt interest expectations that we would have because we have a full picture of what's going on.
Well, I'll ask a specific on that. Do you see the financing assurances that are given to the IMF and the World Bank as a IMF program is put together? Because that becomes a critical thing of what do the various creditors commit, the official creditors commit to doing over a period of time?
Well, so if I think about the last 15 years or so, how that has happened has evolved, right? So let's say the class of debtors that we're talking about right now are the ones that are very low income. They have a reasonable chance of debt distress. And how, for example, the IMF's thinking on that evolved through Greece was a pretty big change, right? It was, we will not lend into this kind of situation except in a systemic idea, and so the policy changed through 2012 and then changed again through 2016 to say we won't lend, but we will allow others to lend, other official creditors. And so, for example, China and Saudi Arabia became big lenders in those situations. And as investors, private sector investors, we have a very good history of understanding the seniority and the expectations of IMF World Bank lending. But we don't have a good history and understanding of what either SOE lending by the Chinese or swap lines extended, how that will be treated and whether we will be subordinate to that. And all of those things play into the price we would expect for the debt ex ante.
That raises a whole another round of questions. That's really good. And so for people's background, I guess, or the way I think in really simplistic terms, in a bankruptcy process, there's debtor in possession. So after the bankruptcy is declared, then new lenders can come in and they have seniority over the old lenders because they're doing something useful and it's agreed on by the group that they can come in and make extra loans. But there's not that kind of organized process with regard to sovereign restructuring processes. So you don't know at the various stages of a restructuring whose credits are going to be treated as senior to the ones you've lent to. Well, that's interesting. And I hope at the roundtable this week, we can discuss things like that. We do have on the table the question of how are arrears going to be treated during the restructuring process. So that can at least give a little bit of a hook into that. Well, let me turn to Nigel, a very successful finance minister and senior government minister in Jamaica. You undertook reforms, and I don't know whether how early you started within this process, but Jamaica is notable in having tackled the debt problem earlier. We've encouraged and really encouraged countries to go as early as as soon as they see a problem, begin talking with people about how to get out of the problem, because otherwise they fall into a debt trap. It's not as if it's going to get better. And Jamaica broke out of that starting in 2010 through 13. So what are and that had to do with domestic debt, which is an issue facing a lot of developing countries. The government may borrow from banks, domestic banks, and that itself creates its own set of problems. How did Jamaica break out of that, and what lessons do you have for the group on debt restructurings?
Right, so Jamaica had an experience of about 50 years in a debt trap, right? For a very long time, we had high, elevated levels of debt for a variety of reasons, which we won't get into here. We learned through that experience that ultimately high debt introduces fiscal rigidity and chokes your ability to respond to crises. And as a result, crises last longer, they become more intense, they become deeper. And you don't have resources to invest in social expenditure and growth-inducing capital expenditure. 2010, we made a stab at it to restructure domestic debt and to engage in a suite of reforms. It got interrupted, and we went again in 2013 and again did a domestic debt
that means you recapitalized banks, or what does that mean?
No. We didn't have a banking sector issue in 2010. We had a banking sector issue in the 90s, and the cost of intervening was 40% of GDP. It was socialized, borne by the government, and in this, let's say, this last 25 years or 30 years of our debt experience is inextricably linked with the banking sector failing in the 1990s. For your audience, by comparison, the financial sector crisis here in the United States in 2008 to 2010 was about 9% of GDP.
So 40%
we had
versus
40% of GDP, and it wasn't a market solution. The government took it on. And we just never worked that debt off, and it brought us into crisis. So we look at the period 2010 to 2023 as sort of one period, but we look more closely at 2013 to 2023, because in 2013, Jamaica was on its knees. And if I were to summarize, I would say, in the context of a social consensus about the need for reform, government can't do it alone. But broad societal consensus, unions, business, academia, government, opposition, Jamaica resolved to move in a different direction. And a combination of laws, institutions, and principled decision-making underpinned by higher levels of fiscal transparency. Just briefly on each of those. Laws. We passed a series of laws on revenue administration, laws that reform the public pension system was reformed in 2017, which led to contributory pension arrangements, laws to do with moving from direct to indirect taxation, and so forth. Institutions, we would have brought into being institutions like an independent fiscal commission, which is in the pipeline, deepening fiscal transparency and giving it an institutional structure and apparatus. We made our central bank independent. Jamaica is characterized by huge levels of fiscal dominance, where the central bank didn't have any choice but to pursue monetary policy that allowed the government to keep borrowing. We dismantled that, and that sent huge signals to the private sector. And as far as laws are concerned, we instituted fiscal rules that the government over the past 10 years governments have followed, that targeted a fiscal balance each year that's consistent with a medium-term debt objective. But you can't just put an institution in place or enact some laws and then say, hey, my work is done. What you need is active, principled decision-making, because the events, dear boy, events, as the former Prime Minister of England said, that come your way can't be predicted. And you have to apply principled decision-making to maneuver through those events. Take what happened over the last 3 years. Jamaica got its debt down from 147% of GDP all the way down to 94% of GDP over a 7-year period. And then COVID comes, a contraction by 10%, debt goes back up to 110. Alarm bells go off, because before we went to 147, the train stop before that was 115. So at 110, are we going to go back? No, we escaped from our fiscal rules, but our policy approach was targeted and temporary, unlike what we saw in many parts of the world where it wasn't targeted. Everybody participated, everybody got, so to speak, and it wasn't temporary. So targeted and temporary allowed us to maneuver through the COVID crisis and maneuver through the inflation crisis that followed with policies that were carefully calibrated. And as a result of principled decision-making supported by fiscal transparency, social consensus, institutions, and laws, Jamaica has the distinction, as at the end of 2022, of being, with the exception of Guyana that discovered oil, the only country in the Western Hemisphere that can say the following 3 things. 1, economic output in real terms is higher in 2022 than it was prior to the pandemic. 2, unemployment is lower in 2022 than it was prior to the pandemic. And a few people can say that, but no one can say those 2 plus the third. Our debt as at 2022 was lower than prior to the pandemic. Our debt to GDP ratio lower than prior to the pandemic. And it's a combination of those that I just described very succinctly that would have allowed us to achieve such an outcome.
I'm glad you mentioned subsidies. We see worldwide the high cost of subsidies that are not targeted. So and also ones that persisted much longer than they'd been intended. And that's a core of the fiscal challenges facing many countries. Did investors come back so after the 2013 crisis, did investors take notice?
Well, it took a long time for people to believe. Important signals had to be sent. Prior to 2013, Jamaica missed its fiscal target every year. In the previous 10 years, every year with the exception of probably 1 year. Since 2013, we've hit our fiscal targets every single year. Right? 22, 23 still out.
Confidence goes up and investment.
Confidence eventually goes up because the signals that are being sent, and we saw earlier this year in other parts of the world how important signals are, right? So, and let's talk about this recent period of COVID, the signals that the government sent about being targeted and about being temporary, escaping from the fiscal rules, but going right back, right, after the storm had passed and not waiting too long, when the the inflation crisis came, resisting the temptation to implement policies that are characterized by huge amounts of fiscal leakage, right? Because you're instead of targeting to the bottom half of the country where the need is greatest, everybody has needs, but it's about prioritizing where the needs are greatest. Those signals were sent to investors that this country is serious. We are not only putting institutions and laws, but we're being principled in our decision making, and that allowed for the economic and employment results I just described.
Thanks much. Tina, short answer, do you invest in Jamaica?
We certainly do.
Can. And in Ethiopia? You could.
We are also invested in Ethiopia.
Interesting. We'll come back to that. Raghu, comment on anything you've heard and specifically, or if you want, on the debt restructuring process, anything that you think should be done to make it go faster?
Well, let me just start with the debtor in possession idea that's floating here. I mean, clearly, countries that are in desperate need and don't have a program in place would benefit from something which allows them access to finance in the short run, prevent a lot of damage to their people, prevent the political sort of upheaval that usually emerges at such times. There are two issues there, however, right? One is you don't want the debtor in possession financing to be invoked to get financing which prolongs the old problem, that they got into trouble because they overinvested in grand projects which led nowhere. They spent a lot on that. You don't want those to be completed off the backs of people who are suffering. What you want is that to be stopped while money is flowing in the right direction. So it does mean a certain kind of targeting of the resources that are raised through debtor in possession financing. And how do you get that? That's very important. Second, I do think that the time for debtor in possession financing is when you lose access. And the sooner it is to that point of lost access, the better it is. How do you determine whether the country has lost access? That's the other issue we need to think about. But I think it's a great idea. It does raise the overall question of whether priority structures over and above the preferred status of the IFIs is something we need to be thinking about. It does open a whole new set of issues. Do countries sort of dilute previous lenders by giving new lenders higher priority, and does this become then a process which is not credible?
Aren't we already doing, so that's the swap line point that was made. So if an external creditor comes in with a central bank swap line, doesn't it take precedence over even IMF and World Bank in terms of the credits, the capital stack?
Absolutely. I think what you're asking for is we need to bring order to this. What is the structure of priority? Under what circumstances does a particular line get priority over the others? And how does this affect the overall resource envelope? And that's something that needs to be discussed. Of course, at the back of it is also what's the restructuring process? How does that take into account all these different priorities? And that, as you know, is a big fraught issue.
This is one of the themes for the roundtable tomorrow, is the predictability of the process has value to quite a few of the participants. Tina raised it. The private sector is happy to consider and analyze situations if there's some predictability in what will happen. And you're describing it as we don't know yet how that will all work out.
Right, and trying to figure that is important. Two other small points. I mean, one is we talked about targeting and temporary and targeted. And what is disappointing is how we've lost track of that in industrial countries, the temporary and targeting aspect of it. And part of, I think, the reason why that is happening is because the politics in industrial countries have become so much more fractured. The consensus that here's how we approach this particular problem has sort of broken down because there are different constituencies who benefit. And instead of saying we target it to this constituency and not to that, now the answer is we target it to everybody. And of course, that implies much greater spending. I mean, think, for example, about how we're approaching climate action. Because it's so hard to get carbon taxes in this country, it's all about subsidies. But clearly that implies an enormous amount of spending from the government to incentivize something which could be done more cheaply, through taxes on the private sector. And that's a place where resources probably are being used in less than efficient ways. Last point, we absolutely need to think about what happens post the restructuring, right? As you said, lots of developing countries in deep stress, but we also know that there were a lot of countries in deep stress 20 years ago, and we did the debt forgiveness, which created space. Some countries used that space very well, others did not. And the question is, at a time where political buy-in for this kind of restructuring is difficult from the government side, of course the private sector side doesn't want this to continue happening, otherwise it loses interest in financing. How do we get countries to commit to a process by which, post the restructuring, there is sensible spending going forward? What are the institutional structures that need to be built with the country itself keeping control over the process by which debt rises, especially given the frequency of catastrophes will probably increase, spending will be needed, but you need to still keep buffers for future events.
This is a really important point of, okay, if we could resolve the past debt crisis, how could we create an environment into the future where more borrowing could be done on a safer or on a more sustainable basis? We are strongly advocating transparency, which was missing. You referred to the previous debt, the HIPC initiative, the Highly Indebted Poor Countries initiative, which then was supposed to create an environment that it wouldn't happen again in, and yet it didn't work. And so we want to strongly encourage more transparency in the new lending that comes on stream. And then also within IDA, we have the SDFP, the Sustainable Developing Finance Policy, which encourages countries to have a sustainable relationship in their new debt. And Ahmed already mentioned Ethiopia has not been doing non-concessional borrowing, which was at the core of the post-HIPC environment. The idea was you were not supposed to borrow on a non-concessional basis after getting debt relief, and that would make you more sustainable into the future. So Ethiopia is trying that now, but he was very careful to say that that's part of the new government of Ethiopia, is trying not to do concessional borrowing. So let me turn to you, Ahmed. You've heard that, so there have been quite a few points made. One is the need for targeted subsidies. Can you do that? And then I'll also mention the fundamental separation that was done in Jamaica of monetary from fiscal policy in order to create a sustainable whole. Can Ethiopia do that? You have a heavily mixed monetary and fiscal policy where the monetary policy subsidizes fiscal and has a dual exchange rate. So, but the question really is, what kinds of reforms do you envision as new international resources come to bear in Ethiopia?
Thank you very much. First, our approach is that since the new government has been in place the last 4 years, we have been doing our own homegrown economic reform program. Its fundamental objective was to sustain growth within the macroeconomic balance framework. And we have analyzed the problem of inflation, the forex challenge, rising debt risk as a binding constraint for the economy at large and for attracting private sector investment. And we have been rebalancing the role of the state in terms of in the economy. We have been creating more space for private sector-led growth, which is very important. On fuel, on subsidies, for example, we are downsizing the wasteful fuel subsidies, which we have been giving generally to the whole public. Now we are moving toward a targeted fuel subsidy. For the first few years of the reform, for example, in terms of monetary finance or fiscal policy, we have fundamentally constrained the national bank borrowing to the government, and it has been significantly reduced. But due to multiple challenges of domestic conflict, drought, and desert locust, and also international food shock, and also commodity price increase, we have to somehow finance these growing needs. Even now, the need for the reconstruction and recovery requires a significant amount of financing, which has to be both domestic and international. That's why our partnership with the World Bank and IMF is very important and critical in this time in our history, where we are moving toward bold reform, but at a time where these multiple challenges requires us to spend more on basic development and social spending as well. So.
All right, welcome back. Just before we end the program today, let me quickly take you through a short interview that we had on the sidelines of the launch of the Fiscal Monitor, where we did speak with Paulo Mendes, who is the Division Chief, Fiscal Affairs Department. And some of the questions that were asked was, what does the IMF think about Nigeria's debt levels, as well as the potential removal of the fuel subsidy issue? Let's take a listen.
And this, as I had mentioned before, is part because Nigeria has very low tax revenues, so that makes it more vulnerable to these types of shocks and tightening global conditions. So that's what we advocate, is raising taxes, which is going to create space not only to manage bad debt, but also to spend on other priorities. And the other part, what we say is that Nigeria is not benefited as much from the windfall of the oil prices in the past, because a lot of it has been spent on these untargeted energy subsidies. So by shifting to more targeted subsidies, you can reduce the fiscal deficit. You can use that resources on other priorities that actually can promote higher growth in the future, on education, on health, and reduce the deficit. So having more targeted energy subsidies actually can be very beneficial both for fiscal and the debt dynamic. I think the improving tax compliance. So Nigeria has one of the lowest tax revenues in the world as a share of GDP. So there's a lot of room by increasing the tax base and the improving tax compliance.
And it's a wrap for today. Thank you all for joining us. I hope you have been, taking a look at what's been happening at the IMF World Bank 2023 spring meetings. On this show, I did promise you that you will have back-to-back conversation. It will be as if you were here with us actually in Washington, D.C., that you really did not miss anything. High-level, high-powered discussions for the past couple of days. I will continue to bring you those conversations, stimulating conversations, I must say, deep topics that the world must really attend to at this time. I am Nancy Najibi, the best you can be. I'm the change that you want to see. Bye now.